Starting from this video, we're going to cover accrued liabilities. Accrued liabilities represent expenses already incurred but not yet paid. In other words, whenever we have an accrued liabilities, the other side must be expense. Well, these liabilities, accrued liabilities, are recorded by adjusting entries at the end of the reporting period prior to preparing financial statements. So whenever you see the word accrued, it must be, the end of the reporting period when you adjust entries. Now, common examples about accrued liabilities includes salaries and wages payable, income tax payables, and interest payable. Now, although you see a lot of payables here, we don't see it that much in the balance sheet because accrued liabilities usually are combined and reported under one single caption, accrued liability, or at best two accrued liability captions in the balance sheet. Accrued interest payable arises with the note payable in connection. So we have the interest payable, right? And when we do this, usually is when we adjust entries. Now, following the previous example about the affiliated technologies, suppose now the fiscal period of this affiliated technology company ends on June the 30th instead of December 31st, which is, so they borrowed money on May the 1st, right? And then now it's June 30th. This is the date of the financial reporting date. So 2 months, you have to adjust entries, but you haven't paid the principal or interest yet. That means you have accumulated the interest. You're gonna put it as expense. So you also have the liabilities. Well, the journal entry when you issue the note is the same. Now we have to adjust entries on June the 30th. We still apply the formula. Now we're gonna have $700,000 and then interest rate 12%, but how many months? Instead of 6, there is 2. We calculated that for 2 months, the interest accumulated is $14,000. We have to put it in expense. That's all the purpose of adjusting entries. We want to have a correct income statement. On the other side is our accrued liabilities called interest payable for $14,000. Well, then, of course, on November the 1st, when the note matures, you're going to pay back principal as well as the interest. Now, you have already recorded 2 months of interest and you have put it in notes interest payable. This time, you're going to debit it, meaning removing the debt. So debit for $14,000. And for the rest, the new year, there's going to be 4 months, right? 6 months minus 2 equals 4. So we're going to do the same thing using the formula instead here using 4. So these are the new interest expense that you haven't recorded. In total is $28,000. So we still debit interest expense for those that you haven't recorded. Also, we need to pay out the note, a total of $7,000. Now you're going to pay $742. Going back to the midterm, we actually have a very similar question. Since it's multiple choice question, it's kind of easier. First, the journal entry side, it must either be A or C, because when we adjust entries, it's always involving revenue or expense. So hint here, we have expense here, expense here. We don't have expense on D. So D is excluded. Next is about the number, either 258 or 129. Now the actual calculation using the formula is the principal times the annual interest rate. And people have no difficulty counting there are 2 months. The key part is, do you divide by 6 or do you divide it by 12? The interest rate is 12 months. You are using 2 months of the 12 months, so divided it by 12. Answer is 129. Now, in the next video, we'll continue and talk about the salaries, commissions, and bonuses.